Hey there. Today, we're going to tackle a really cool and simple technique. We're talking about a classic tool, but we're going to use it for one very specific, very powerful purpose: getting a super quick read on what the market is feeling. All right, let's get right into it. All right, so picture this. You're staring at your charts, and you've got that one big question nagging you. Who's actually in charge here? Is it the buyers or the sellers? How can you just get a feel for the mood, the vibe of the market, without getting totally bogged down by 10 different indicators? Well, what if I told you the answer could come from watching just one key level? That's right, just one. It's called the pivot point, and it basically acts like a line in the sand for the day's trading. Now, to really get this, let's use a super helpful analogy. Think of the market like a game of American football. The pivot point, that's your 50-yard line. It makes perfect sense, right? In football, if your team is past the 50-yard line and in enemy territory, you've got the upper hand. Well, it's the exact same idea in trading. Whichever side of the pivot point the price is on, that tells you everything about who's got control, the bulls or the bears. And honestly, it boils down to a super simple rule. Price trading above the pivot point, that's bullish. The buyers are in control, pushing things up. Price trading below the pivot point, that's bearish. Sellers have the reins. It's that straightforward. It's a quick and dirty gauge of the market's bias for the day. Okay, so that's the theory. Sounds great. But what does it actually look like on a real chart? Let's take a look at a couple of textbook examples where this rule just worked like a charm. Okay, check this out. This chart is a beautiful example. You can see the price opened way above that central pivot point, the PP line, and from there, it just never looked back. The buyers were totally in command, and the price just smashed through every single resistance level. R1, R2, R3, gone. This is what a classic textbook bullish day looks like. Now let's flip the script and look at the opposite scenario. Here, the price tried to push up to the pivot point from below, but no dice. That level held like a brick wall. And once it was rejected, oh man, the sellers took over completely. The price stayed under that pivot point, screaming bearish sentiment, and ended up dropping nearly 300 pips, a huge move. So, right about now, you're probably thinking, wow, this is it. This is the simplest, most effective strategy ever. And it seems like it, right? But like any good story, there's a plot twist coming. I mean, it seems too easy, doesn't it? Just buy if it's above, sell if it's below. It's gotta be foolproof, right? Wrong. And honestly, figuring out why it doesn't always work, that's probably the most important lesson you're gonna get today. All right, let's break this chart down, because this is where it gets tricky. Take a close look. The price first dips below the pivot point. So our simple rule says sell, 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 sell. But oh boy, if you'd sold right there, you would have been in a world of hurt. The market did a complete 180, shot straight back up through the pivot point, and just kept on climbing. The buyers ended up owning the day. That, my friends, is a classic fake out. And this is what brings us to the real punchline of this whole thing. That simple rule, it's a great starting point, a fantastic guide, but it is absolutely not the whole story. So why does this even happen? Well, the source material puts it perfectly, and I love this line. Traders are fickle. And they really are. How traders feel about a currency, about the market, it can change in an instant. You can have a totally bearish morning that suddenly flips into a ragingly bullish afternoon, all because of some new data, a headline, or just, a collective change of heart. The battlefield is always shifting under your feet. So here's the bottom line. This is the big takeaway. You absolutely do not just blindly buy when the price is above the pivot, and you don't just sell when it's below. That's a recipe for disaster. Instead, you use it for its real power, as a tool to help you figure out the overall market sentiment. You have to combine it with other things, your candlestick analysis, maybe some moving averages, other indicators, to confirm what you're seeing before you even think about placing a trade. Think about it this way. The pivot point shows you where the 50-yard line is. It's a fantastic reference point to see who has the advantage right now. But it doesn't show you the playbook. It doesn't tell you the whole game plan. So the real question I want to leave you with is this. Now that you know what it's great at and you know where it can trick you, how are you going to fit this powerful little tool into your own trading strategy?